And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. I'm your host, Lance Roberts. Yes, we're live. We're back in the studio after a week without power and all other kinds of turmoil. I said that, normally when I go on vacation, something tends to happen. Usually the market crashes. Well, that didn't happen, right? Markets did just fine. Of course, we got hit by a hurricane, had no power for a week. My power didn't come back on until Saturday night. So that, and then of course, 2 deaths. Shannon Daughtery from 90210 days. She passed away after a long battle with breast cancer. And of course, Dr. Ruth, the sex psychologist, died at 96. She lived a very long life.
One more.
That's right.
Ken Hoffman.
Oh, really?
Ken Hoffman passed away Sunday morning.
There's your trifecta.
Houston Chronicle, Houston Post columnist for a long time.
Yeah.
Great guy.
Well, there's your 3.
Yeah.
So always comes in 3s. And then, of course, over the weekend, attempted assassination. It's been filling all the headlines for the last 24-hour news cycle. Tell you what, though, Donald Trump, man, 3 baby mamas, right? 34 felonies, and he's been shot. This dude has more street cred than a rapper. So at this point,
nice.
Anyway, all right, got a lot of things to get into this morning. It took Brent a minute to catch on to that one.
Oh no, I'm still enjoying it.
So, anyway, a few things to talk about, of course, while it was gone. We got in the CPI inflation report, which came in weaker than expected. PPI, the producer price index, came in a little bit hotter than expected. Now, that's not really a good sign because what that means is that prices are going into the producers and they're not able to pass that on to the consumers. So that is going to wind up impacting earnings as we go forward. So again, something to continue to pay attention to, but the overall trend of inflation continues to decline as we expected. And this is now setting the Fed up to start cutting rates as soon as September. Now, it's possible, given some of the recent economic data that we've had, that the Fed could could cut rates at the end of this month when they have their July meeting. It's not a very high probability, but they could come out if they wanted to shock the markets and really catch the markets by surprise, could do a rate cut in July. Most likely, the first rate cut will come in September. And that'll be 25 basis points. Right now, the CME, which is kind of keeps track of the Fed funds futures and what the bets are being made on that, there's about a 90% probability of a cut of 25 basis points by September. So most of the market is now expecting a 25-point cut in September. Now, the risk to that, of course, is that the Fed, for some reason, say the numbers in August, come in a little bit stronger than expected, whatever it is, and the Fed doesn't cut rates in September. That could disappoint. If expectations remain where they are and the Fed doesn't cut rates, well, that could disappoint the markets. And again, we've got a market that's very extended and very stretched right now, very optimistic. If you take a look at positioning, household allocations are now at record highs. And if you take a look at sentiment and options, et cetera, as well, those are all suggesting that investors are really kind of all in the markets right now. So again, everybody's very aggressively invested in the markets. Markets continued to kind of grind higher over the last week while it was gone. Nothing really happened of consequence. And again, I wish there was a lot of excitement that we could talk about this week, but not a lot of excitement going on. This market just kind of continues to grind higher. We're back on that buy signal, which is, again, keeping these markets moving higher at the moment. And again, so there's really not a lot to worry about, in terms of the bullish trend at the moment. But it is important to understand that investors are very, very optimistic about stocks in general. Take a look at put options as an example. Nobody wants put options at the moment, and that's basically insurance. I could buy a put option on the index to hedge part of my portfolio, and the general attitude of investors right now is like, I really don't need it. Markets are just going up. There's no risk of a crash. There is only an 8% probability, as measured by the options market, of a 10% correction by September. So again, the options players, those investors that are playing in the options markets, they have no expectation of a correction of 5 to 10% anytime soon. So they're simply saying, I don't need the insurance. So this is kind of like driving your car without insurance, right? And it's fine because most of the time you get to where you're going, and that's the general answer. I don't really need insurance because I don't ever get in wrecks until you get in a wreck. Then you wish you had insurance. And that's kind of the whole point here with the markets where they are at the moment. But again, let's talk about what you need to know before the bell this morning, get you caught up after last week. Markets, again, as I said, markets back on a buy signal, still overbought here a lot, but again, this has kind of been the case here for a while. We've been overbought here for a time, and this is not new, by the way. This is something that we saw last year in particular, because last year at this time, as we were kind of going through the markets, we were talking about this whole issue that the markets were moving higher, everything was fine, and this is really kind of what was going back in May and June, July, and again, very similarly, we stayed overbought for a period of time, and it seemed like, oh, this market's just going to keep going up, we're just overbought, and we're going to stay that way, that should just kind of become the normal thing. But again, each one of these periods where we were exceedingly overbought for a period of time and remained overbought here for a while, eventually devolved down into a correction. This was 10% last year. We had 5% earlier this month. So again, earlier this year. So again, we're going to have another correction. And again, when markets are just kind of stuck here in this overbought territory for a period of time, it's eventually going to reverse because it's just sucking all the buyers into the markets. And so again, when there becomes a point that somebody says, hey, I'm out, there's no buyers there, and the buyers are sitting at a much lower price. And that's why markets will go through this correctional phase at some point. The only question is when. And I know we talked about this for a while, is that a correction is coming, 5 to 10%, before the election, most likely. That's your time frame. The question, the timing, of course, is do you get out of the markets now and then just kind of wait for the correction? But the markets can keep going up. And that's always one of the real challenging parts about managing a portfolio. And again, we kind of saw this really kind of following October of last year. We had this correction, and then the markets just kind of gravitated higher. And all through here, there was plenty of reasons for the markets to correct, and then they finally did. But the problem of selling too soon is you say, well, the market's going to correct, so I sell out here, as an example. And then the market keeps going up, so now you're not in the markets are going up, then the market corrects and you're right back to where you were previously, when you sold out. So, that's the challenge of trying to get the timing of managing these corrections, correct. And this is why we talk about making small moves, small changes, just rebalancing risk, reducing positions that are really, really extended. Just those small changes, and that'll keep you invested in the markets while the markets are rising. And then once the correction does begin, that gives you the opportunity to go ahead and decrease your exposure some more, add some hedges, and then wait for your next opportunity to put some of that cash that you had raised previously back to work. But that's just part of this overall process of managing money. But again, the point here is that we're very similar to what we saw previously, where this market just kind of grinds higher ad nauseum, remains overbought. You kind of get to this point of complacency where it's like, market's just not going to correct again, and then it corrects. And that's just the way it works, and that's why you have insurance. So again, that's what you need to know before the bell this morning. When we come back, we'll talk about the broken clock syndrome and how it captures the bulls and the bears, and we'll talk about the reasons why when we come back from the break. I'm Real Lance Roberts. Welcome back to the Real Investment Show this week. Glad to be here. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So JC says that Lance went on vacation, the market rallies, see a pattern. No, that's not the pattern, actually. This was an anomaly. Normally, when I go on vacation, the market crashes. True story. So, I should say it crashes, but we generally have a sloppy trading correction. Generally, when I go on vacation, then the phones are ringing off the hooks from clients and wanting to know what's going on, and I wind up working most of the vacation, and that didn't happen this time, so worked out well. Just I missed a hurricane, so I'll take what I can get. Although I didn't quite miss it. I did come home to a tree limb fell on my daughter's car, so she's very upset because it dented her car, and then we had some minor house damage and no power until Saturday, and had to throw away. We had just bought groceries like 2 weeks ago, freezer, all of our freezer stuff for the month. And yeah, all that was out in the trash today. Yeah. So
It's nasty.
it is nasty. And it's a lot of money, unfortunately. Just groceries aren't cheap in general anymore. So, all right. A couple of things to get into. So I wrote an article on Friday and talking about the broken clock syndrome and what it's always interesting because historically, there's kind of this commentary where bears are like a broken clock. They're only right twice a day. And and really that's a true statement. And it certainly seems that way in a lot of cases because you hear a lot from the bearish commentaries like, oh, the crash is coming and it's, the debts are going to cause a crash. The deficit is going to cause a crash. It's the end of the dollar. There's all these very bearish stories and they don't come true 9/10 out of the time. Now, every once in a while they get it right? And that's the broken clock theory is that, bears always bearish and every now and then they get it right. But that broken clock syndrome also encompasses the bulls because the bulls are always like, hey, markets are always going up, be invested. Markets only go one direction. They only go higher. And eventually something happens and they're wrong too. And so this is really kind of the juxt of the article that I wrote on Friday is really kind of going through this. And this is why, not being bullish or bearish is very important to your outlook. And so if your outlook is you're always looking for the negative, you're always looking for the event that's going to cause a major market crash, that's fine, but you're going to miss out a lot on the upside. And conversely, if you're always bullish and you ignore all the risk, eventually you're going to get swept up in the correction when it occurs, because these corrections will always happen. Now, the corrections in the markets, and this is where the bulls do get it wrong. They're like, well, if you take a look at the history of the markets going back over time, and what you'll see is that bull markets last a whole lot longer than bear markets. And that's a true statement. Markets are up 100, 200%, and then you have a correction of 30% or 40%, whatever it is, and then the markets go up again. And that's a true statement. Bull markets last a lot longer than bear markets, but what they don't tell you is that markets spend about 85% of their time getting back to even from the previous correction. Only about 15% of the time is the market making new highs. And, this goes back to, just thinking about logically how things work, is that a record is a record for a reason. It's because that the market or a sprinter or whatever it did, or whoever it is or whatever it is, just achieved a new level that was previously set by something else. So you take Usain Bolt, right? One of the greatest sprinters of all time. So he has the world record as being the fastest sprinter alive. Eventually somebody will beat that record. May have already, but somebody will beat it. Nolan Ryan has records for strikeouts and pitches that probably nobody will ever match, right? Just for the time he did. But at some point, the record's going to be beaten. It could stand for a very long time, but eventually it'll get beaten. It's the same way for the markets. When the markets are making new all-time highs, right? It's setting new records because it has just finished recovering from where the previous record was set. So we set a record high in the markets in January of 2022. And it took basically about 2 years to get back to even and start setting new highs again. So if you take a look from that peak to where we are now, what has been your return overall? See, the markets always look at, this market's rallied X percent from the lows, right? But most people didn't buy the lows. They were in the markets at the peak. They rode the market all the way down. And then they spend a year and a half or two getting back to even, whatever it is. And they haven't made any money. And so really, the return in the portfolio is from where the previous high was. But this is the point about, this broken clock syndrome, is that your job as an investor is to really step back from these bullish views and these bearish views. Hey, the market can only go higher for this reason. Oh, the big crash is coming. You better get out of the markets now while you still can. That's just going to get you caught up in a whole lot of psychological biases that are going to lead to lower rates of return over time. And so this is really kind of the purpose of the article that we wrote on Friday, and you can go to the website, realinvestmentadvice.com, and kind of read through it. But one of the things that is very important, again, is just understanding that valuations matter, but they don't matter today. And this is really kind of a key point, is that if you go back in history, the markets have traded at high valuations before. They can continue to trade at very high valuations for a very long period of time before valuations matter. And they will matter eventually. The economy will slow down. Earnings expectations, whatever it is, are not going to be met. There's going to be disappointment. The markets will have to reprice those valuations. Because what's valuations, right? Valuations are simply what the market is willing to pay for $1 worth of earnings. And right now, we're willing to pay $35 for $1 worth of earnings. Well, at some point in the future, the markets are going to say, well, you're not going to make $1 worth of earnings, so I'm going to have to revalue what I'm paying for those earnings, because I'm not going to pay $35 for $1 when you're not making $1. And that's going to happen, right? And then at some point when that valuation reversion occurs, that is simply just the market repricing expectations for earnings and what they're willing to pay for those earnings. But that's why valuations eventually matter, but they don't matter today, because today expectations are very high that earnings are going to continue to grow. Earnings are going to continue to outstrip the growth rate of the economy. That's the expectation right now, all across the board. No matter really who you look at, whether it's Goldman Sachs or Morgan Stanley has some of the most optimistic earnings projections I've ever seen going out into 2025. They're currently pushing up towards $290 a share. S&P, the company behind the S&P index, their earnings are only at $242. So Morgan Stanley's $50 higher than even S&P is, who runs their own index. So go figure that. But optimism is very high. And again, if these earnings are met, then maybe valuations aren't as expensive as they appear to be at the moment. Because if earnings do rise, that will help offset that. But if earnings are rising and earnings are growing at the rate that the markets are expecting, markets are going to continue to pay up more and more and more for those earnings. So valuations don't historically come down. They keep going up as earnings are growing. It is only when at some point there's disappointment in those earnings that all of this matters. So again, just, this is very important to, pay attention to, because again, you hear a lot of very bearish stories right now because markets are going up. There's also a lot of very bullish stories out there of why the markets can only go higher. It's AI, it's this, it's that, the other thing. Just understand that markets go up and they go down. As we talked about in the last segment, the timing of that's the challenge for us as investors, is managing that volatility risk and understanding that at some point that reversion will occur, but being too cautious too soon can be just as detrimental as being overly exuberant at the wrong time. And this is why it's tough to manage money, and it's not easy. All right, take a quick break. We'll come back. Got some more topics to get into this morning. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com, or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791, or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Today is a very sad day because we had a very serious set of deaths in our house.
The Real Investment Show podcast.
It's been just a very traumatic few days. We lost our new coffee maker, we lost our air fryer, and we lost our oven when this power surge came through the house.
Same show, your schedule.
That's how big the surge was coming through the house, but I've not had coffee for 2 days, so just beware. I don't know what you're going to get this morning on the show, but
at realinvestmentadvice.com.
I'm a little cranky.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Comment on our chat channel this morning says that Mike Leibowitz on Thoughtful Money mentioned that we need to be the eagle in the current market. How do we be the eagle and know when we should buy a dip versus be more cautious and wait for a deeper pullback? Mike's right, and something we talk about a lot, and that's really kind of the whole purpose of this article that we wrote on Friday, talking about the broken clock syndrome. In fact, if you read to the bottom of that article, we kind of go through a series of steps to take in terms of thinking about your portfolio and how to kind of manage the risk in it. And you know, this is the big challenge, right? As I was saying earlier on when we're doing our market overview, saying, you know, if you got out of the market too soon, okay, I think a big correction's coming, so I'm going to get out of the markets. I'm going to wait. I'm going to buy the dip. That's fine. But if you got out too early, the dip came and you basically wound up buying right where you got out. And so you really didn't do yourself any favors whatsoever. And that's the challenge. So this is why we talk a lot about, you know, taking steps on a regular basis. Okay. And you know, reducing equity exposure by taking positions that have outgrown their position weighting in the portfolio. So let's say a stock's 2% weight in your portfolio is now 3, trim it back to 2. Right? You're not out, but you've raised some cash. And you've reduced your risk in that stock by reducing the number of shares in it. If you got stocks that are grossly underperforming, find out why. Right? Are you wed into this underperforming position because you've got some thesis that's not coming true? Did you make an error in buying that position? Or did something happen to the company that's causing it to underperform? Or is it a really good company fundamentally just in a bad sector at a bad time in the markets, and when a market rotation comes, that should perform, right? So in that case, it could be a hedge. But see, you've got to determine whether or not you're just wed to this underperforming position just because you bought it and it's losing money, so now you don't want to sell it just because you don't want to admit you're wrong. Or if it's really just a very good company in an out-of-favor sector that will catch a rotation and do well. But if it's underperforming and it's lagging and it's not a great company with great fundamentals and great earnings that are just in a bad sector. You can go through healthcare as a good example of this right now. Some great companies in there just out of favor. Or is it a bad company? And if it's a bad company and you can't separate those two, you need to sell it and get out, right? Just reduce that risk in your portfolio, because if it's a bad company and it's not performing in an up market, when the market goes down, it's going to outperform on the downside when the market declines. In other words, it'll go down more than the market. It won't hedge you. So if you can't tell the difference, sell the position, reduce that risk. But that's the process that you do while the market's rising. You're constantly raising cash and rebalancing risk in your portfolio. And then that way, when you do get the correction, you've got cash to allocate. You know, we did this back in February and March. We were talking about on the show that, hey, we're taking some money off the table on AMD and NVIDIA, et cetera, because they're getting really extended. The market's very overbought. And we're about to start that process again, where we'll reduce risk in the portfolio, raise a little bit of cash. And then when the market does give us a correction, we'll put that cash back to work. We can buy the shares of the same companies back, right? It doesn't matter what we buy, but we can put that cash back to work at a better price. But that's the portfolio management point. See, the problem with your statement is, how do we know when to get out and then when to come back in and buy the dip? And you will never know that. And that's the problem with trying to be a market timer, which is where you're trying to get all out or all in. I want to miss the decline, and then I want to buy the dip. Well, the problem is you're never going to do either. You're going to get out too early, miss the rally. Then you're going to wind up buying the market. You're going to say, fine, the market's just going to go up, so I'm going to get in now, and you're going to buy it close to the peak. Then the market's going to decline, and instead of buying the dip, you're going to convince yourself the market's just going to go lower, right? And then you never get back in when the market starts rallying, because you just get yourself caught up in these psychological arguments over and over and over again that keeps you from acting the way you should. And again, the best way to invest is do the thing that makes you the most uncomfortable. If you're doing the thing that makes you the most uncomfortable, you're probably doing the right thing more often than not. And that's, in other words, when markets are declining and everything is doom and gloom, that's when you should be buying. That's the most uncomfortable thing you can do during a decline, is buy something. And when markets are rallying and it looks like they're going to go to the moon, the most uncomfortable thing to do is sell something that's performing really well, right? Reduce that position size. But I'm going to miss out on the upside. It's uncomfortable. Tends to turn out to be right more often than not. Is it always right? Is it 100% the right thing to do always? No. But more often than not, if you just resign yourself to do the most uncomfortable thing, you tend to do better in the financial markets over time. Because you're buying when nobody else wants anything, you're selling when everybody wants it. But that's how you make money, right? I mean, if you think about investing, the very basis of investing is that I'm buying an asset today to sell at a higher price tomorrow. The problem for most individuals is they never get the sell part done. They get the buy done, but then they want to hold it forever, no matter what. And they're never going to sell. But that's not the job of investing. Investing is simply buying something today that I'm going to sell at a higher price tomorrow. It's all ethereal pieces of paper. We're just trying to convert an investment into a gain. That's our job, right? That's all we're supposed to be doing. So it's a good question, and I appreciate it. And again, this is, Mike's right? Our job is to be an eagle, just kind of, and this is kind of what I was talking about this morning, is that our job is just to overlook the landscape. Forget all these narratives. Half of these narratives that are out there, more than that, probably 75% of all the narratives that are out there are being pitched by somebody that's got a product to sell you, right? If you're a big gold bug, right, you come up with all the reasons why now's the time to own gold, right? And if you're a big stock bug, this is why stocks are only going to go to the moon. Whatever it is, right? Somebody's trying to sell you a product. Your job is to stay above all of that. Get above all those commentaries. And then look down and just weigh the evidence for what it is. And if you want to buy gold, great, buy gold. If you want to buy Bitcoin, great, buy Bitcoin, right? But get out of the narratives. Because these are all just tradable assets. At the end of the day, they're just tradable assets. Gold is not a currency. Bitcoin is not a currency. Stocks are stocks, right? I mean, they're just, again, you don't even own the shares. The shares are in street name held at your brokerage firm. You don't own them. They're just ethereal pieces of paper. Our job with all of it is simply to say, what did I buy it at? And is it a good time to sell it and make some money? Because if we don't sell it, we never make any money, right? That's the whole point. We got to make money with it, and that's our job. So whatever it is, again, just sit above all of these arguments and all these debates and all of these reasonings. And the more doom and gloom they are, or the more super optimistic, bullish, the world never is going to stop going up scenario, you need to discount those the most. As we talked about before, when you look at a bell curve of distributions of events, the most optimistic and the most pessimistic are very, very, very low probability events that are not going to occur. The vast majority of the events are going to be in that center part of that bell curve. That's where 85 to 90% of all the event outcomes are going to occur, and they're not these end-of-the-world scenarios one way or the other. They're going to be these more normalistic events, corrections of 10 to 20% on one side, market rallies of 10 to 20 to 30% on the other side. That's just the markets. And we just need to learn to invest and operate within that parameter. So again, just want to be the eagle, look down, get rid of all these arguments. Because again, as we said earlier, once you pick a side, if you're bearish and you pick that side, it's like, I'm a bear. All you see is the bearish outcomes. All you see, all you'll read is just information that supports your bearish view. And anything that doesn't support your bearish view, then you disregard that. Same thing for the bulls. If I pick the bullish argument and I'm only bullish all the time, I discount everything else. And the problem with that is that I'm discounting the risk. And this is the point of one of the big points of the article on Friday, is that both bears and bulls are wrong eventually. The problem with the bull argument is that they're wrong at the worst possible time. Because when the bulls are wrong, that's where capital destruction comes from. When the bears are wrong, you're just simply missing out on capital gains. You're not losing money, right? You're sitting on cash. You got cash buried underneath your mattress in your house, whatever it is. And yes, you're losing money to inflation, but you're not losing physical capital, right? When the bulls are wrong, you lose physical capital. And so there is a difference, but both are wrong. And the question is what side of wrong do you want to be on? And our job is to try to understand the differences so that we can participate in markets when they're rising, try to avoid as much of the downturn as we can. You're not going to get all of it. You're not going to get all the upside. You're not going to get all the downside. Be good with that. Be good with the fact that you're only going to get 80% of the upside, and be good with the fact that you're going to capture about 20% of the downside. And if you can live with that, you'll be a much better investor over time, because you're not taking on excess risk on the upside, and you're not sitting in cash while markets are rising, expecting the worst of possible outcomes. When the big correction starts, whenever it starts, yeah, you're going to capture about 20% of it, but you'll be getting out of the market. Leave the other 80% to everybody else that wants to write it down. Same thing when markets bottom, start to go back up, you're going to miss the first 20% of the rally, because you've got to wait for the technicals to confirm that the bear market is over and the bull market is back, and then you get in. And you'll get 80% of the upside. But that's just managing risk. So again, it's a great question, right? It's a great question, but it's difficult to do. And this is why, if you can't do it, hire somebody who can. Or if you can do it, great. Just separate out the arguments and understand the fundamentals, understand what you're looking at, understand the dynamics, and just resign yourself to be open to the bull argument and the bear argument. Weigh them accordingly, and then manage your risk along the way. All right, come back. We'll finish up the show. Good question. I appreciate that very much on the chat. We'll come back, finish up the show right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So just kind of taking a look at what's coming up today in the markets. Not much economically speaking, really earnings-wise. We have Goldman Sachs and BlackRock out today. Banks, on Friday we had a couple bank earnings that came out, and they were okay. Nothing really much to write home about. It'll be interesting to see if Goldman Sachs and BlackRock come through with good earnings. Goldman Sachs usually does well on their trading revenues. Can't tell you why. But they usually do well in that, so we'll see, kind of how they perform today. But again, not a lot today. Economic data tomorrow, though, starts to pick up. We get retail sales tomorrow, export prices, home builder sentiment, more bank. We have a lot of banks this week. So tomorrow's Bank of America, Morgan Stanley. We have United Health tomorrow, Charles Schwab, Interactive Brokers, Progressive, PNC Financial, State Street Bank. And then on Wednesday, start getting into Johnson & Johnson, United Airlines, ASML, Alcoa reports on Friday, Kinder Morgan, as well as Steel Dynamics. So we start to get kind of into the early part of earnings season outside of the banks. The banks are always kind of the lead off into earnings season. And then on Thursday, Netflix. So we'll start getting into some of the other bigger names. Now, next week, once we get to next week and the week after, that's where we get Apple, Microsoft, all those. So the next 2 weeks, I would expect a bit of volatility. Now, markets are opening up pretty sharply this morning as the markets are looking at a variety of things. One is the rate cut from last week, and now that's really starting to set in that a rate cut is coming, so markets are rallying on that. A lot of headlines this morning are suggesting that the market's rallying because of the assassination attempt, because this is going to give, in theory, a big boost to President Trump in the polls, and is going to start to pull more and more of the kind of the individual voter that was non-decisive at this point into voting for Trump. So again, the markets are rallying on that. Expectations are that he wins the presidency, we'll get tax cuts. That's good for markets. He'll implement economic policies as he did before in terms of oil and gas drilling, et cetera. So we should start to see, potentially energy stocks, rally today as well. We'll see how this plays out. I wouldn't assign a tremendous amount of the market to that narrative just yet. We're still 3 months out from the election. A lot can happen between now and then. So kind of making a bet today on an election outcome based on this one event. The markets do this all the time, right? They just grab a headline, they run with it. This is, stepping outside of the picture for a moment, more of this rally today is really based on the idea the Fed's going to cut rates. And we've got a lot of momentum in the markets right now. There's just nothing kind of stopping this train at the moment. So again, I think that's more of the story here. But, the headline is it's because of the attempt over the weekend. Maybe it is, maybe it isn't. One of my stories kind of going back to 2000 as had started on the radio with Brent back in 2000, 2001, and markets were in the middle of the dot-com crash. And in the morning, before the market opened, IBM reported they were going to lay off 5,000 workers. And the stock was down sharply because they're going to lay off these 5,000 workers. Right, it's bad news, right? It's not great if the company's having to lay off 5,000 workers, obviously something's not going on. So that would be the theory, right? I'm going to sell off the stock. By the end of the day, the market had bounced and IBM was up sharply. And the headline was IBM up sharply today because they're laying off 5,000 workers. Well, it can't be both. But see, the markets are always looking for a narrative, right, to justify action. And this is always the case. And this is why you've got to be very careful with headlines, because the markets are just trying to grab, especially the media. The media is the worst because they're just trying to assign a reason. They don't know why the market's doing what it's doing in reality. But CNBC needs a headline. Market's rallying today because of the Trump assassination. Market's rallying today because Morgan Stanley laid off 10,000 people, whatever it is, right? I need a reason, and as humans, we need this, right? Just as part of this is why we look at it. You take a palette and you throw a bunch of paint on it, there's just a bunch of dots, and your brain will start trying to see a pattern in it. It's just how we work. So we need psychologically this reason. Why is the market rallying today? Because of this? Probably not. It's really just we got a lot of momentum. We have a lot of positioning on the bullish side right now. There's an asset chase going on in the markets because portfolio managers are underperforming this year pretty markedly because they haven't had 35% of their assets in 10 stocks. So they're lagging the markets. There's this need to catch up. And so that's a lot of what this is. But again, the markets, the media, you, me, everybody else, we're always looking for why is this happening today? Because, right? It really doesn't mean anything. It just, and going back to what we were talking about in the last segment, this is why you kind of got to step back and just say, look, let's just look at the markets. And this is why technicals are great, right? Technical analysis gets rid of all the headlines. It is what it is. You're just looking at price action. And why is technical analysis important? Because that is the looking glass into the market, the mind of the market. Remember, the market is just millions of individuals all around the world buying and selling at any given nanosecond, right? There's just millions upon millions and billions of transactions that are going on all over the world in the financial markets, all over the world, all at the same time. And it's just half the people are buying, half the people are selling, and there's transactions that are getting met in the middle at some price. They're just agreeing to a price and they're executing at that price. That's what the market is. So what technical analysis does is it just gives you a window into the mind of what these millions of minds are doing all at the same time. Are they buying or are they selling? And it gets rid of all the headlines. It gets rid of all the narratives. It gets rid of all of the, the emotional biases, etc. The things that hurt us as investors. Strip all that out, look at the technicals and say, what's going on here? Markets are going up. We're on a trend right now. The market's overbought. There's a little bit of risk here. We got to understand that. But the bullish trend is intact. There's no reason not to be invested in equities right now. The markets are doing nothing wrong. There's nothing undermining the market at the moment. Doesn't mean that won't change. But the technicals will tell us when that's going to change. Good example. Over the last few weeks, actually over the last couple of months, breadth has not been great in the market. The advanced decline line was declining as markets were rallying. Now, this is called a negative divergence. And that suggests there's risk in the markets. On Thursday and Friday, this past week, the market rotated. The advanced decline line has now hit a new all-time high. So 2 months of negative divergence were wiped out in 2 days. Again, another reason that the bulls remain in control for right now. Excuse me. But that's what we're dealing with. Anyway, I would expect some volatility over the course of the next few weeks. And as we start getting into late July, ahead of the Fed meeting, and into early August, I think that risk of a potential 5% correction, maybe 10, becomes a much more viable risk as we get into August, September, October. Probably September, October more than anything else. But somewhere within that 3-month span, I think you get that correction. But again, the market could rally a good bit more before we get there. But again, that's kind of the outlying risk. Right now, futures are pointing higher. The S&P's up about 0.5% this morning. NASDAQ is up also 0.5% this morning. Oil prices are up to $82 a barrel. Dow futures are up about 190 this morning. They're up about half a bip as well. So markets are going to open up fairly strongly this morning. And we'll see how, but again, we've seen this before. Market opens up strongly and immediately sells off. So, that's why risk, we've got to manage that volatility. But, part of our newsletter over the weekend was talking about put options. And everybody hates put options right now. Nobody wants them. Put options are extremely cheap. And if you want to think about hedging your portfolio, one thing you could look at doing is buying a put option on the index for early November, mid-November. That gets you past the election, gets you some fairly cheap insurance to cover your portfolio during the summer. So you can kind of go on vacation, whatever you want to do. And if the market declines, that put option will hedge it. And again, you can buy them fairly cheap right now. So again, it's kind of like auto insurance, right? You buy it, you're going to spend money. Hope that you don't need it, right? Hope the markets just keep going up and making you a bunch more money. That'd be great. But just in the and again, the insurance is a waste, right? Because you spend the money on the put option, it expires worthless, and the markets are higher and you're in good shape. But the whole reason for a put option is that in the event that 5 to 10% correction does come along, that put option now grows in value and hedges off the risk of your portfolio. It's cheap insurance, just like having car insurance. You hope you don't ever need it, but you're glad you have it when you do. So, just something about I go into that a good bit of detail in this weekend's newsletter. It's on the website, realinvestmentadvice.com. While you're there, be sure and like and subscribe to the channel. We certainly appreciate it. We need more likes on our YouTube channel, so that would really help us out. Also, get our daily market commentary. If you go to the realinvestmentadvice.com website, right on the front page, you can subscribe to our daily market commentary, our newsletter, our daily blogs. All those are there for you to help you be a better investor over time. The blog this morning on the website, the newsletter is on the website now. It's all there for you. realinvestmentadvice.com. Have a great day, and thanks for joining me this morning. Glad to be back, and we'll see you back here tomorrow for the next edition of The Real Investment Show.